Hello, and welcome to Bite Size Legal, where we tackle legal issues one bite at a time. My name is Drew Jenkins, and I'm an attorney licensed in Georgia and Alabama. And today we're going to take another bite out of depreciation. If you remember last week, we gave the overview of what depreciation is. It is the IRS recognizing that certain types of property have a finite life, meaning they will have value today, but in the future their value will go to zero or to a salvage value. Now, while we all hope that real estate will continue to go up in price, we must recognize that the buildings or improvements upon that property, if not maintained, will decay and reach a valueless point essentially. And so depreciation is a way for us to recognize the declining value of the improvements, not taking into account maintenance considerations, but it's there for us to take as a tax loss. Now, what the IRS giveth with the one hand, they can take away with the other. And this is why I always advise that you talk with your CPA or your accountant to determine the right depreciation schedule. But you also need to be aware of what is called depreciation recapture. The simple example, we'll start there. If you buy a property for $100,000, and for whatever reason we consider the land to be valueless, just to make the example easier, right? And you sell it 5 years from now for $150,000, you should be aware that you will pay taxes on the gain, that being your current sales price less your purchase price. So you will pay taxes on $50,000. Now, because you held the property for greater than a period of 1 year, and it being real property, it will be taxed at the long-term capital gains rates. However, during that same period of time, if you took depreciation, you're actually going to have a second column, or I should say a separate column, where you have to acknowledge that you have been telling the government every year that the property is worth a little bit less in the current year than it was in the previous year. And so you will actually build up a depreciation expense account that will have to be repaid to the government at the time of sale. Again, keeping things as simple as possible and not to overcomplicate, let's just say that we depreciated over the term the improvements down by $50,000. So now we sell the property for $150,000. We can do the simple calculation and say, all right, $50,000 is our simple gain, right? Sales price minus your purchase price at long-term capital gains rate. Now, what is going to happen to all of the losses that you have been accruing to the tune of $50,000 over the last several years? Well, the IRS has a separate basis account that is originally based on what we talked about earlier, being the value of the improvements within your purchase price, and you have lowered that by $50,000. So what the IRS will see is your normal long-term capital gain of $50,000. And they will say, now wait a minute, you have actually taken losses to the tune of an additional $50,000 by using your depreciation schedule. We are going to need you to repay that. And what is the rate they are going to use? You are going to be required to pay back Section 1250. It's called Section 1250 of the Internal Revenue Code. It will be paid back at a special depreciation recapture rate, which is effectively ordinary income up to a maximum of 25%. Now, if you fall into the highest tax brackets, right, there are other considerations, and you should have a CPA to work with on that. But for most of us, we'll take it to our ordinary income rate, and then as our ordinary income rate exceeds 25%, then it will stay at 25%. So let's look at a little bit more of the math on this. Your long-term capital gains rate, let's just say, is 20%, right? That's the category that you are in based on your income. And then you have this depreciation recapture that is going to be at your ordinary income rate or at 25%, whichever is lower. And so in this way, the government is able to recapture all of those losses that you've been taking over the last several years. So that is something to keep in mind, is that depreciation is not free money. It is a way for you to acknowledge that improvements on property without proper maintenance are going to have a finite life, and it helps you out a little bit on your taxes because it reduces how much you owe year over year. However, when and if you sell the property at a gain, you will actually wind up paying more in taxes than you would just with a back of the envelope calculation. So just keep in mind as you're looking for properties to purchase, either to sell or to rent out, that as you're taking depreciation, you are going to need to pay that back to the government. And the calculation to determine the tax bill on that is separate from the calculation you use for your normal sell price less purchase price for the gain. So don't let yourself get hit with an unintended tax at the end of it. It will actually be filled out on Schedule D and will flow over to your 1040. Now, if you take a loss, that's great. Well, I shouldn't say that's great. You don't really want to take a loss, but you get what I'm saying. You've already taken the losses in previous years, so it's not going to hurt you too much. And in fact, you may be able to sell the property for a little bit of a loss, and you're not actually going to have a gain at all. But be careful, because it is a depreciation recapture. If you sell the house for the spread, which is the difference between its current tax basis, i.e. your starting taxable basis less your depreciation basis, then you will wind up owing depreciation recapture on the amount of money that exceeds your current depreciable basis account, right? So just keep in mind that it can get a little bit hairy. And that is our bite for today. I'm bringing all of this together so next week we can have a quick Christmas present, which is going to be 1031 exchanges. And it's a way that you can see how you can continue to roll from property to property without triggering either your normal gain or depreciation recapture at the time you're switching between properties. I hope you found this useful and or enjoyable. As always, leave me comments down below, and if you're watching on WeChat, keep it in the thread, and see you next week.